This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Now we're going to look at professional ethics. This is very much a revision of what you will have encountered at F8, but it remains very, very important for P7. There are very frequently questions dealing with ethics. The questions tend to be a bit harder, a bit more involved, with perhaps more finer judgments required, but you have to know ethics, you have to know the threats, you have to know the safeguards. So the IESBA's code, which has been really adopted in the ACCA rulebook, the way it is set up is that there are certain fundamental principles which are around, and these fundamental principles are subject to threats, and if you can anticipate a threat or know there may be a threat, then you can try to avoid that or to mitigate it by putting in place safeguards. This is known as a conceptual framework. Sometimes the safeguards will be able to eliminate a threat entirely, but the key phrase is to reduce threats to an acceptable level, because it is recognized that it is in many cases impossible to reduce threats down to zero. Absolutely, we need to get them to an acceptable level. Now, the 5 fundamental principles which should be etched on your mind are these. There is integrity, being straightforward, honest, sticking up for what you believe in, not kind of giving way easily on an argument if the finance director, for example, is wrong and you believe you are right. Integrity also means not turning a blind eye. So if you see something that looks wrong, obviously there might be less bother in an audit if you pretended you hadn't seen it, but that's not being honest. That is not showing integrity. There's objectivity, avoiding bias, concentrating on really the matter in hand, and so on. We don't want undue influence. We don't want to do something to please someone. If a company wants you to sign off a cash flow forecast for the bank, and of course they could be leaning on you fairly heavily because maybe the future of the company depends on it, but you have to remain rather stern and rather objective and think whether or not the cash flow forecast actually makes sense. Professional competence and due care. For example, make sure that audits are staffed by people of the right experience. Spend long enough, and if you've got the fee wrong, then it may still mean that you have to spend longer than the fee might actually suggest to do a good, competent, first-class audit. It also means staying up to date with the latest accounting standards and auditing standards, so that you give a very professional, current service. Confidentiality. You should not disclose information unless you are permitted to by the client, or unless there is a duty to disclose it on the law, or you have a professional right to disclose it, for example, if you're defending yourself in a court of law. Now, this used to be very, very strict, but we'll see in a subsequent chapter what now should happen if you find that your client is not complying with rules and regulations and laws. The duty to be confidential, to maintain confidentiality, has been a little bit relaxed in certain cases. And professional behaviour, to comply with the law, to avoid action which discredits the profession, for example, placing adverts for your work which denigrates the opposition and so on, is certainly not adhering to what would be regarded as being professional. So these are the fundamental principles that we need to apply. Independence. Independence is not mentioned as a specific fundamental principle, but it is a combination, really, I suppose, of integrity and objectivity. Integrity means you're able independently to stand up for what you believe in. And as regards objectivity, it means you're not going to be swayed by other factors. And it's very important that auditors are seen to be independent. What we have to do is to identify threats in our independence, evaluate their significance, and to apply safeguards to bring them down to acceptable levels, or else we decline the work. Current issues on independence for stock exchange top 350 companies in the UK, the auditor has to go out for tender every 10 years. That doesn't mean the auditor has to be changed, but it has to go out to tender. It's important that you always bring to bear professional skepticism. This idea that you don't go in believing everyone's telling lies, but neither do you go in believing everyone's telling the truth. They're not necessarily deliberately lying, but we're all prone to optimism, error, and the like, which can really mean that the figures that we're auditing are in some way undermined or wrong. And also, you should bear in mind that if you're dealing with a public interest entity, like a listed company or perhaps a charity, really where there's many stakeholders who are maybe going to be hurt if the audit isn't done properly, there are usually stricter requirements as regards being careful about applying the fundamental principles like independence. So here we have the independence of mind, objectivity, professional skepticism, independence of appearance. You might be independent, but you have to be seen to be independent. You have to be seen to be beyond reproach. There should be this professional skepticism, a questioning mind, critical assessment of audit evidence, wanting to see more information if you think the audit evidence is not really very convincing. You have to be aware and alert to anything which might be causing material misstatement. And as I said, it's this fine line between being too trusting and too suspicious. Threats to independence come from these: self-interest, self-review, familiarity, advocacy, and intimidation. So let's go through those. First of all, self-interest threats, where you are encouraged to do something because perhaps it makes you richer, or increases the chance that the client will stay with you, or maybe even avoids some sort of embarrassment. So here are all the type of threats. Again, these will be fairly familiar. A financial threat, owning shares in a client. You want the share price to go up, but if you give a qualified audit opinion, the share price might go down, so you're not seen as being independent. A close business relationship with the client is inevitably going to almost get onto a familiarity threat here, but you don't want to. It's harder, shall we say, to maintain professional skepticism if you have a close remuneration with a close relationship with people. Family and personal relationships. There are no hard and fast rules about what is family. Obviously, your brother would be, your spouse would be, but it's kind of your, fifth cousin twice removed. Is that family? And even less, is there any specific qualification about what makes a personal relationship? How good does a friendship have to be? It's left up to the auditor's judgment, really, whether or not they could really declare that they're independent if you are very good friends, say, with a finance director. And this is something that sometimes audit partners drift into. They become friendly with the finance director. They go round to each other's houses occasionally for a meal. Families the same age, they go off on holidays together and the like. And suddenly people who didn't know each other, after a few years, have become very, very friendly and could not be seen as being independent anymore. Loans and guarantees between the client and the auditor. A loan is really only okay if it's at arm's length and in the normal course of business. So a bank, if a bank is your client and it provides you a loan and it's a normal rate of interest, that's okay. But if it was some other sort of trader who gave you a loan and they didn't give anyone else loans, then this is deeply suspicious. Gifts and hospitality are not allowed unless they are of clearly trivial value. And really the test is, if the gift or hospitality is something worth having, or something you'd like to have, it's probably not ethical to have it. So it has to be kept at a really kind of low level. Going out to a very ordinary restaurant at the end of an audit is probably okay. Going out to a kind of 3-star restaurant is almost certainly not okay. Overdue fees put you at really in the pocket to some extent of the client. You want the fees to be paid, but the fees are more likely to be paid if the client gets a good audit report, and so you're going to be influenced. There, your self-interest is not to incur a bad debt. Contingent fees, clearly wrong. So if the client says your audit fee is 100,000 if it's a clean audit report, but only 50,000 if you modify your opinion, there is clear self-interest there in giving a clean audit report, and it is clearly a big threat to you being independent. High percentage fees. If for non-public interest companies there is no specific figure given, but for public interest companies you don't want more than 15% of your total fees arising from that single source, that public interest company, for more than 2 consecutive years. The regulations do sometimes allow a little kind of peak in the fees as long as it goes down again, because there you might have done a special job and then it kind of reverts to a normal level. And of course this is here because you don't want to lose a lot of fees by upsetting a client. Lowballing, going in with a very low estimate for the fees for the audit, and you may even make a loss in that audit, but you're desperate to stay friends with the client, because if you stay friends with the client, then you might get some more lucrative work later. And recruitment from the client or for the client. If you recruit, let's say, an accountant for the client and the accountant turns out to be useless, then next year when you come to do the audit and find this useless accountant has messed stuff up, you might be inhibited from reporting all of these errors your suggested recruit has made, and again that's not independent. Self-review threats. Recent service with the assurance client. It means you might have prepared something, then you jump to the auditor and you are going to be reviewing maybe information which you have prepared. You have to be careful in other services. So maybe you prepare the tax and then you audit the tax, and that's not bringing any form of independence really to that. Similarly, if you prepare the financial statements and then audit the financial statements, no good at all. You're not allowed to do that at all if it's a public listed company. If it's not a public listed company, you must have 2 separate teams doing it. So one is genuinely checking on the other one's calculations and competence. Careful with valuation services. Again, if you value, say, buildings, and then the buildings appear in the non-current assets, in the statement of financial position, which you have to audit, then, it's very easy just to kind of wave it through and say, well, we valued it, therefore it's going to be right. Be careful with taxation services. Be careful with internal audit services. Again, internal audit is going to be doing a lot of checking internal control, and then the external auditors come along and maybe kind of recheck it. Do you really want to be criticizing your your kind of colleagues there. Corporate finance, not allowed to deal in or promote shares. That makes you too dependent, really, on what you've previously said, maybe, or what you've previously ordered. You've audited a company, you say to people, maybe go and buy its shares, and of course you want its shares to do good. That kind of links over into advocacy threats a little bit as well. Problem with supplying multiple services. In most of Europe, we're allowed to do it. It is controversial. Large firms at least can use separate departments. But the controversy is increasing. And in America, firms of accountants are only allowed to be auditors. And if they're auditors, they're not allowed to be anything else. I mean that for one client. So for one client, if I'm the auditor, I can't then produce the taxation or maybe make representations on their behalf to the taxation authorities, anything of that sort. If I want to do the tax for a client, I then can't also be the audit for a client. If I want to do some sort of management consultancy for a client, I can't be the auditor of the client. And the danger, as I've said, is that you want to keep on good terms with the client, therefore maybe weaken your audit work in a hope that this very valuable and lucrative other service work comes your way. Familiarity threat. Here, close relationship, members of the assurance firm become too sympathetic, and essentially skepticism goes out of the window. It's very difficult to remain skeptical if you know people well. So, particular with public interest companies, the partner in charge of the engagement has to rotate at least every 7 years. And a new set of eyes will be coming into that. Recent service with the audit client, employment with the audit client, family and personal relationships, all coming in here to potentially raise the problem of familiarity threats. And remember, what's important for many of these threats is to be seen to be independent. You might in your heart of heart believe you're independent, but how does it look to external people, particularly if something then maybe goes wrong with the audit and they can come back with accusations and said, well, you didn't look very hard for misstatements because you're best chums with the finance director. Intimidation threats, where the assurance team is deterred from acting properly because of actual or perceived threats. Very occasionally it might be physical threats, but more likely it could be maybe the threat to withdraw the audit from you. It could be the threat maybe to report you to one of your regulatory authorities, make some sort of complaint about you, generally make life a bit difficult for you. You have to therefore try to make sure that when you are performing audits that you do everything as perfectly as you can, because if you once kind of drop your guard slightly and maybe do something not properly, it opens up this little possibility that there are going to be intimidation threats. Some threats, of course, can be really classified under several different headings. So if you became friends with the finance director, it is obviously, or let's say if your brother was a finance director, then obviously there's a familiarity threat. But there's a kind of self-interest threat as well, because you don't want a big family upset. You don't want the rest of the family kind of, falling out with you because you landed your brother in trouble. And there can even be a kind of intimidation threat. If your brother is the one who's 3 years older than you, and the brother when you were kids was the one who always beat you up, and there's a kind of a almost bullying relationship between you and your big brother, then of course that kind of psychology lives on and can still be present in intimidation. Confidentiality. Confidentiality, here we're saying you have to be permitted by law, and in particular money laundering regulations or proceeds of crime regulations are what we'll be looking at. We'll be seeing that very shortly. Required by law, permitted by law, authorized by the client, and then the difficult one, professional duty or right to disclose. And this is one that we're going to be looking at later when we come on to look at the non-compliance of clients with laws and regulations. So if your client was covering up something which was actually a danger to the public, then almost certainly you're going to be permitted to disclose that to the authorities, though you should take legal advice on the matter beforehand. Conflicts of interest. Conflicts of interest come up reasonably often in PE7. A conflict of interest is not listed as one of the standard threats, but it can be very real. It can be auditors versus clients' interests. So what happens if we are a company, an auditing company, which markets accounting services as well, writes up small companies' sets of accounts, and we are the auditor of a company which writes up sets of accounts. Obviously, we're going to get to know all about the charge-out rates of a competitor, and that's maybe not great. Or clients versus clients' interests. We represent two clients. One wants to take over the other. Wants us to give advice on that takeover. And of course, we've got all sorts of interesting confidential information about how this client is doing, how the target company is doing, what sort of profits it's making, what its 3-year budgets are looking at, and so on. And this leakage or potential leakage of information between the two clients via the auditor is a bit disconcerting. The key thing is you must tell the clients and get their permission if you are to continue acting for both sides. You must ensure that there is no kind of contamination going on here. You must have separate teams, say in a takeover situation, and they mustn't chat to each other. They mustn't disclose information to each other, which could be useful either in a takeover or in defending it. You will have confidentiality agreements between the clients and, of course, with your staff members that they mustn't talk. Guidelines on confidentiality, training and confidentiality are all very important. And maybe sometimes advise a client saying, I'll do this if you want, but really, don't you think you'd feel more comfortable if you got a completely independent accountant to do it instead of me? Now that's gone fairly quickly through revision, really, of ethics. If you look on our website, you'll see a lecture called Neeson. Neeson is a word question. The question is from the P7 December 2010, and it looks at aspects of confidentiality. And I think you should fairly quickly go and see that. There hasn't been very much new in what we've said about confidentiality, but it's very important that you get practice